Hey everyone, welcome back to another FBC video. Today we will be talking about the different ways you can generate money for yourself. Before we begin, we hope you enjoyed watching our last video about the rich versus poor mindset and learned the different ways a billionaire thinks. Please let us know in our comments if you have any suggestions for us to promote our content in a more effective way. We always appreciate feedback.
Please make sure to follow our Instagram at Reedy_FBC, as we are starting to post weekly investment strategies and mindset tips. We hope that the videos we put out on our YouTube channel and the weekly post on our Instagram will help you understand a different perspective to business and finance that will help you to become financially secure in the future.
All right, let's get started. Today's video is about the different ways you can generate money for yourself. Let's start off with talking about the three main types of incomes, which are ordinary income, passive income, and portfolio income.
The first type of income is the ordinary income or active income. Ordinary income is the money you get from working. If your parents work for a company, they are receiving ordinary income. When working for a company, you get a regular salary every 2 to 3 weeks in the form of a paycheck. Out of the three main types of incomes, this is the type of income that is the most common. In this case, you are working for money.
The next type of income is passive income. Passive income is the money you earn when you're not physically doing work. This can be the income earned through businesses, writing books, recording songs, or airing commercials. Let's take the example of writing books. Let's say you write a book and publish it. People will buy the book from bookstores or online stores. In this entire scenario, all you had to do was write the book, publish the book, and sell it at bookstores or online platforms. Then, when people start buying your book, you start to generate money without having to do anything more. In this case, money is working for you.
The third type of income is portfolio income. This is the income generated through stocks and bonds. Let's say you buy a couple of shares of Apple and expect it to rise in the upcoming months. A month later, Apple reports good news and the share price of Apple skyrockets. Seeing that it is at a high price, you sell it and relish the profits you made. In this scenario, all you had to do was buy a couple of shares of Apple and you made money without having to do anything more. In this case, money is working for you. Keep in mind, however, you can also lose money through investing in the stock market, but do not worry. We will be making another video soon talking about the stock market and investment strategies you can use to maximize the profits you get from your investments. Stay tuned.
In the cases of passive and portfolio income, money works for you, whereas in the case of ordinary income, you have to work for money. Robert Kiyosaki states in his book, Rich Dad, Poor Dad, that the key to becoming rich will be your ability to convert ordinary earned income into passive income and portfolio income. Even if you are working for money, you can still have money work for you when you invest in stocks or start up a side business. In this way, you can use the money from your assets, such as your side business and stocks, to generate additional income streams.
Now, let's talk about assets and liabilities. You may have a general understanding of what assets and liabilities are, but we are going to go a little bit more in depth to analyze different asset classes and types of liabilities. Assets are anything that you own that is worth something or can be turned into money. Take a look around your home and mentally make a list of what is valuable in your room. Autographed baseballs, a violin, or antique furniture could all be considered assets because you can sell them in the future and make much more money than what you had bought it for.
So now, what are some assets that you are more likely to buy or sell? There are many different types of assets like expensive paintings or classic cars. However, we are going to talk about some of the main types of asset investments you are most likely to make. The main asset classes are bonds, equities and stocks, real estate, cryptocurrencies, and commodities.
We are going to discuss some of these asset classes in this video. However, it is only a general overview. But do not worry, we will be making videos soon that will explain each of the asset classes and how you can invest in these asset classes more in depth. The first asset class are the bonds. Bonds are like loans that can be traded between people. Let's say that you have a $100 bond and you sell it to a lender, or a person that buys the bond. You will be able to spend that $100 now, but you will need to pay it back to the lender sometime in the future. At a certain date, the bond expires and you must repay whoever is holding the bond on that date, along with the interest the bond has accumulated. For the person or entity using the bond, it becomes a liability. For the person that buys the bond, it becomes an asset. However, bonds are mostly used in the government when the government needs funding for projects. Ultimately, bonds are a safe investment that you should direct some of your money in your portfolio to.
The next asset class we will talk about are the equities and stocks. Both stocks and equities represent the ownership in an entity or a company and are traded on the stock exchanges. Stocks and equities are often used interchangeably, but essentially they both mean the same thing. Investors usually buy shares of companies that they believe could grow and generate increased revenues. When company revenue increases, the share prices also increase. The opposite could also happen as well, as sometimes companies might not do so well and share prices can plummet, which might make you lose money. But again, don't worry because we will be making videos on how you can choose good stock investment. So stay tuned.
Real estate includes homes and investment properties. Some of the main categories of real estate investments include residential properties, such as housing or apartments, commercial properties, such as skyscrapers and office buildings, industrial properties, such as warehouses and storage units, retail properties, such as shopping malls, and mixed use properties.
Cryptocurrency is a digital version of money or a form of payment where transactions are done online. What sets cryptocurrency apart is that it is a decentralized cash system. A decentralized cash system is a network powered by users without having any third party involvement, such as a central authority or a middleman like banks. There are many different types of cryptocurrencies in the market today. Some of the more popular ones include Bitcoin, Ethereum, Ripple, Litecoin, and Monero. However, be wary in this because cryptocurrency is very volatile and risky.
The commodity asset class is an asset class that is generally traded on different exchanges like the New York Mercantile Exchange. There is a huge variety of commodities traded. There are generally four main sub-asset classes: crude oil, power, natural gas, precious and base metals such as gold and copper, and agricultural products such as corn and coffee. There are many factors that can move a commodity's price up or down, which include political tension, inventory levels, weather, and overall economic growth. Amidst the recent COVID-19 pandemic, the price of oil went negative. How could oil prices be negative, you may ask? Well, when supply is greater than demand, so prices become cheap. Oil companies had excess oil that they didn't have a place to store, while consumers were stuck inside of their houses and didn't have a use for oil.
Now let's transition into talking about liabilities, which are the opposites of assets. A liability is something a person or company owes, which is usually a sum of money. Examples of liabilities include mortgage, loans, and accrued expenses. In the case of loans, it is true that you are getting money. However, within a certain time, you are required to pay that entire sum of cash loaned from the bank or another entity with an additional interest. This means you are paying more money. Depreciating value items such as credit card debt, computers, and electronics are also considered liabilities.
The key to becoming rich and being financially secure is to maximize assets and minimize liabilities. There are instances where some liabilities are necessary for the benefit of a company or an entity, such as loans or immediate monetary needs. However, just by being aware and tracking your liabilities and assets is a good start, as you can keep liabilities in check and make sure you are accumulating assets.
I think we can conclude this video now. Let's do a quick recap on what all we covered. First, we talked about the three main types of incomes, which are ordinary income, passive income, and portfolio income. With the portfolio and passive income, money works for you, whereas in the ordinary/active income, you work for money. Next, we talked about assets, which are anything that you own that is worth something or can be turned into money. Then we briefly explained the five main asset classes, which are bonds, stocks, real estate, cryptocurrency, and commodities. Lastly, we talked about liabilities, which in simple terms takes money out of your pocket, such as mortgage, loans, and depreciating value items.
Subscribe to our channel. Share this with your friends also, as we are trying to promote our content to a wider audience. Thank you for watching, and we'll see you in the next one.